There's a lot going on right now in the markets. We've got volatility, markets in a downtrend, the Fed raising rates. This week, they start pulling liquidity from the markets. We know how much the markets love that liquidity, not to mention inflation and all kinds of geopolitical issues. So, is it a good time to buy, meaning risk on, or to sell, risk off? Lots to talk about. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. What you do here, I do apply to our overall models and portfolios that we manage for individual and clients. So, if you find some value, please do consider subscribing. So, as I mentioned, lots going on here, a lot of volatility. Tech down as much as 28%, S&P almost 20% with the bounce back, and we've had a bounce the last week. Is it to be respected or to be sold? Risk on, risk off. We're going to talk about that and a lot more. So, today's agenda, we're going to talk about our market cycles, cornerstone of our process. Go show those charts, the big charts, technical analysis. What are the charts telling us? What direction are we going? Sector spotlight. What are we buying? What are we avoiding? And most importantly, game plan going forward. Let's go to the big board. All right, as always, we start off with our cycles. Where are we right now? Okay, we have definitively been in cycle 4. We've talked about this for quite some time. Although last month looked a lot like cycle 3. Why? Growth slowing, inflation accelerating, a little bit of stagflation. Don't want that. That's a 70s kind of environment we do not want. We feel we're going to continue to stay in cycle 4 as inflation decelerates. Now, why? What am I looking at? Here's CRB index. When you see this, clearly a straight line up 163% from its low, grinding higher barely, but really driven by oil, obviously, natural gas. We are seeing some rollover in several sectors, lumber being one of the big ones, copper being another one of those as well. So we do feel that slowly we will see inflation decelerate. I am not at all saying it's going away overnight, but we hope to see it grind lower. And you can see here on a chart, the big one that's rolled over, that red line, is automobiles. So that is a good sign, one of the big indicators for CPI. Now, here's PPI, monthly rate of change, one of the things that we do look at, okay? It has slowed. That's what we're seeing overall. That's why we feel inflation should slowly decelerate. Now, that being said, the Fed thinks it can get to 4% year-end. No way, okay? When you look at that, they have to, over the next 8 prints, coming in below 0.15% growth, okay? When we've been averaging 0.5% year to date. So that's why that number is not going to happen. You also have some other factors obviously going on in agriculture. Not going to talk about it yet because it has not hit us. The Fed, speaking about the Fed, this shows you Fed rate hike. So 25 basis points is normal. This shows you the projection. They were talking about 10.2, did 2 last month. Now they're saying 7.22. So you take that times 0.25%, you're getting about 1.8%. All right. Now, this weekend, Fed Weller came out. We're going to do whatever it takes. Heard that one before, right? We're going to raise 50 basis points each meeting as long as we have to. We'll see. Okay. Another big part, we're raising rates. We know that. That's why the market's freaking out. But liquidity, we talked about that. The Fed dumping all this money in there. Now, part of the program, I mentioned this in the beginning, they're going to start pulling liquidity out. One of the reasons the market's held up in the last month is because in the last month, the Fed bought $170 billion worth of bonds, if you can believe that. So this is the big thing. This is your overnight repo. It should go over. Now let's look at a couple other areas that obviously are concerning. Housing is the big one. That can help, okay, with CPI. The housing market boom is over, right? We're seeing new home sales, biggest monthly drop in a while, seeing all kinds of articles about that. Here's a chart. Record low in U.S. says it is a good time to buy a home. So, had some clients we talked to said, hold off, should see things come down. We'll see. It looks like we're heading in that direction. Right, next, I'm going to talk about the consumer. Bostic, one of the chairs, Fed chairs, going to take some time for excess cash to flow out of the household bank accounts. Alrighty then. All right, next up, we got Janet Yellen. U.S. households are in good shape with money to spend. Well, folks, I'm here to tell you that's not the case. Personal savings rate crashing. We're at a low last seen, you ready? 2008. Okay, so if personal savings are down, what are people doing while inflation is up? To continue to buy goods and services. If you guessed, credit cards, look at that line. You talk about a trend. That is not a good looking trend. Also, from our research, we're seeing delays on payments, charge-offs, etc. Not to the degree of '08, obviously, but definitely seeing a different change in this market. No, the consumer is not that strong. Let's go to the big charts. All right, so first up, when we're looking at the charts, a couple things. All right, normally I show midterm, long-term, the weekly and monthly. I'm not going to do that because we're in a downtrend. Those charts are down. The most important chart right now is the short-term, and that's where I want my focus to be. So we're going to take a look here. What exactly do we see? All right, a couple things. Down today about 0.9%. The big thing was about a week ago Friday, all right, we broke through a key level of support via this Fibonacci, link up here and what that is. Okay, somebody stepped in on the institutional side and put some support there on the VIX and also the overall market. The other thing down here I'm looking at is rate of change. I do a 1% factor, so up or down 1%. Look at all those movements above that versus what we were seeing last year. Okay, again, confirming what a volatile market it has been. I'll talk about a VIX in a second here as one of my indicators. NASDAQ has been really beat up, down 28% a week ago. Like the S&P, made a counter trend move. A bear market bounce is what I believe it to be. Okay, why do I believe that? Here's 29 to 32, should say 29. You know, every time you've gone down, you have these bounces back up. Now, last week, not a lot of volume. I'm going to focus on that in a second, okay? That shows you 29. This shows you 07, 09, right? Come down, right? Then we work our way back up. We have a 14%, a 28% bear market bounce before we find a bottom, all right? So, not surprising on what happened last week, all right? Next up, let's go to Sector Spotlight. All right, so first up with Sector Spotlight, talk about the U.S. dollar, right? We've had a huge run up this year for the dollar, one of our top performers year to date, and you've come down. Not surprising. S&P up, dollar down, very common. Down here I have a correlation chart, right? They're correlated, they move together. They're actually negatively correlated because when, again, confirming when the S&P went up, the dollar went down, but today, S&P down, dollar up as we start the month. This did not update through Friday. All right, next up, I called this my most important chart of the year. Why? It's bonds, okay? Did come back a little bit today. We hit big-time resistance, okay, 3.2%, and we're finally coming down. This is what I've called the pain trade. We are waiting for this patiently, right? It's been a tough year in the markets, but the bond market, as it made that move, had the worst start of the year ever, okay? Or since 1973. Very close, okay? So we're sitting there in the 50-day moving average. Not surprising little move today because of some of the inflation information that came out this morning in Europe. But we're looking at, and I did add today in the close, on one of our bond holdings. I've got short-term, mid-term, long-term, international, emerging markets, a lot of different sectors, but still very much underweight, waiting for that break and this could be a very nice move as we go forward. As part of that, you've got utilities, okay, which makes sense. Today it was down because the bond market was up. All right, another thing we're looking at over here is gold. We've talked about for a while. All right, not a good day today. Very much correlated to the Treasury, okay? So last week, when yields were down, gold went up. That's what we're looking for. Have a decent, medium-sized position, looking for both Treasuries and gold to be a better position as we go forward, and most importantly, okay, as volatility kicks up. And another thing we looked at adding into was mastered limited partnership, because oil does continue to go. We're looking at that. We also have some individual holdings as we go forward. Now, one of the questions is, what are some of the signs or signals that you're looking for, okay, for the market to break down? So what I'm showing you here, okay, are several different indicators that I look at on one. Now, obviously at the top, we've got SPY, the S&P 500 ETF. But down to each line here, I have first off volume. And you can see volume last week as the market went up, volume went down. Not a good sign for the bulls, okay? One of the reasons I think it was a bear market bounce. The other thing, you can go back to 2020, look at that spike in volume over there, massive numbers, okay? You're talking about 400 million shares a day in some cases. Here we're about, our max out is about 175 million shares. So I'm looking to see more volume before I think about meaning that we are in a true bear market. Next one is put-call ratio. Puts, people betting the market's going down, versus calls, betting the market's going to go up. Okay, pretty tame. This is put-call ratio, very tame. Again, if I go back to last year, okay, versus where we are, a little bit of elevation, but not a lot. So a lot of complacency in the overall market on the trading side, okay? The next one, companies above their 200-day moving average. Now, if you look over here, you're looking at 25, it's only 25%. We bounced off that last week. We're about 40. To change the trend, you're looking at above 60. We're nowhere near that. Okay, the last one is, not least, is the volatility index, the VIX. Okay, it's been pretty stable. Okay, we closed today just a little bit above 26. And again, if you go over here, we're talking about an 80 number. All right, our max has been about 35. I still think we go higher here. It's one of our holdings. We are looking at, we've made an investment that the VIX is going to go higher. So this shows you, sure, it's been a tough year. Yes, it's been very volatile, but you're still not seeing those signs that this is a full-on sell-off type market, okay? Next up, last but not least, is the high yield spreads, okay? This is your 10-year versus some of your high yields, your junks, okay? Had a big move, counter trend move last week, not surprising again with the S&P up. I still think this is another thing you look at, and if you see here versus, right, look at 2020 where we are now, right, we still have a way to go, but we do know that the junk bond market has dried up, so you should see some more movement there. That's another big sign that I look for. Let's talk about game plan going forward. All right, so let's wrap things up here real quick. Not a lot. I hope to be quick here. But the Fed, way behind the curve, yield curve, watch the Fed, watch what's going on as we go forward there. Will they continue those 50 basis point raises? Transition purchases to new cycles. As I said, when you look at it, bonds, gold, cash right now, cash is king, not a bad place to be. Okay, opportunities, sell on strength. So if you still have some holdings and you're worried about them, sell on strength, buy on weakness. So again, today the bond market was down. It was red, so it was an opportunity to add to some of our positions. That's where we are. We're about 24% in bonds. We're about 12% in currencies, which will be gold and the dollar we talked about. Only have about 20% in equities. and then about 15% in our cycle assets. So still sitting on quite a bit of cash waiting to deploy into this area. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.